I think the free market it adjust itself. Anytime that the government has put their hands on something, it's always caused a surge in demand or the need for people to jump in the market. And then what that does with home prices is obviously pretty evident. If you ever look at your mortgage over the whole amortization, and especially with rates like this that's going on right now, you're basically paying double the interest.
Mm-hmm. What can a mortgage broker do, or what do you do to like differentiate yourself from others? Like, is there certain traits or certain skills or certain assets that you can offer other people that other brokers can't?
Well, let's put it like this.
Welcome to the Little Did You Know podcast. My name is Morgan Little. I appreciate you being here. My guest today is mortgage broker extraordinaire, Martin Wichlacz. He's going to give us a masterclass in the mortgage industry, so stay tuned. So, Martin, tell me, what's it like to be a mortgage broker?
It's $1 million question, isn't it? It's a lot of late nights sometimes.
Nice.
Unlike the banks, I work weekends.
Right.
I work Sundays.
Nice.
Sometimes at 9 p.m. at night
Yep.
when I'm trying to go to bed.
I can relate. Yeah.
Yeah. At the end of the day, it's like you have deadlines. You have to meet them. Some people, you'll be working on a file and then you'll have a phone call and somebody else has a deadline, and then I'll be working on their file and trying to work on the last file, and then somebody else calls me. It's always it's always a shuffle. I'm playing triage all the time.
Right. Can you do that one more time? Is this how you work on a file?
Just randomly typing.
For sure. I mean, obviously I can relate, similar client-facing industries. But in a nutshell, what does a mortgage broker do?
Basically, my job is to, a lot of times for buyers, pre-qualify them for a purchase, make sure they're not making a bad move, make sure that the realtor has a solid deal that he could bring to the table. That's super important. Basically, there's so many things that I don't do. Basically provide loans for people, make people's lives better, analyze their situation, whatnot. Sometimes I have to take that hat off, put on the tech hat on, and be like, okay, this is how you send me a document. This is how you, this is how you boot a computer. It gets that basic sometimes. Then sometimes I take that hat off, and it's like, okay, marriage counseling. All right, we're gonna do a spousal buyout here.
Right.
Let's talk to your, your lawyer and see, what each individual needs out of this refinance or spousal buyout, we call it. So yeah, there's a lot of different hats that you would have to wear. Then my favorite hat, the marketing hat, is like, okay, time to do some marketing, time to put out some advertisements and stuff like that. So that's fun. But actually, since I don't know if you know, but recently I was also promoted to director of operations.
Ooh,
so for my brokerage, then I'm managing everybody's stuff as well. And then
congratulations.
Yeah, thank you so much.
Does that take away from the time you are spending, on your job as a mortgage broker?
It's burning the candle both ends for sure. And that's not a problem to me because I'm a hard worker anyways. I love to work. I'm a workaholic actually. So yeah, it's odd. Some people will go home and watch TV or whatever. I'm just like, what I'm going to do? I'm going to go do this for the brokerage, get the training set up, get the marketing set up, get the hiring set up and stuff like that. So,
which is probably why you got that position in the first place, because you go above and beyond. And you haven't been at that brokerage for that long, is that right?
I've only been there since, I would say November last year.
Okay.
So coming up to my 1 year, I guess. Yeah.
Cool. Well, that's awesome. And so what can a mortgage broker do, or what do you do to differentiate yourself from others? Like, is there certain traits or certain skills or certain assets that you can offer other people that other brokers can't?
Well, let's put it like this. Brokers call me to close their deals, to co-broker their deals. Where I am right now, we do have access to private funds, private lenders, and private investors that I didn't at my other location. And Those are the 911. I have a deal. I'm showing you the deal now. We have to close tomorrow, right? So meanwhile, I'm working on this app. And I got to stop at what I'm doing and focus on something, play triage essentially, right? Which isn't too bad. It's manageable, right?
Yeah. I mean, you have to have the personality to be able to, be in this position in the first place, but to be able to, pivot, switch, jump on that task, So makes sense.
Yeah. I don't actually fold under pressure. I work better under pressure. Nice. So that's, I guess, my saving grace for a trait, right? So.
And okay, so what you spoke about private mortgages, and I don't know if you can say, maybe it's too big of a range, but what's a private mortgage looking like rate wise at this point?
Best case scenario on a private mortgage, you're looking at maybe like 7.99%.
Oh, that's actually not bad.
It's actually not too bad. However, with a private mortgage, you got to understand a few things. There's going to be lender fees and brokerage fees, right? Yeah. So brokerage fees could range anywhere between, and depending on the deal, depending on the size of the deal and the amount of work, sometimes a brokerage fee could be anywhere between 1 to 3%. Where a lender fee could be anywhere between, I would say, 1.5 to up to 5%.
Wow. Okay.
Right.
That's big.
So, if you take 8% and then you throw a 5% lender fee on it and a 2% brokerage fee, that's reflective of the rate. You could be paying, 19% interest rate, or you could be paying 10% interest rate with a 4% brokerage fee and a 5%.
And those are paid up front.
Yeah, exactly. That's the difference is the rate would be your monthly payment, and then the rest would be paid up front, usually by the equity. But that's a super extreme situation. If you, in a nutshell, on average, I would probably say on the first mortgage, you'd be paying anywhere between 11 and 12% interest. Well, interest overall for the year.
Right.
So
okay.
That includes the interest rate and the fees, essentially. That's how you have to look at it, actually.
Okay. Still, honestly, not that bad because, coming from, I do a lot of work in the kind of off-market stuff, and private lenders are, at 15, 20% a lot of times. So, so that's not bad.
Yeah.
And, but, and now talking about, more traditional rates, fixed versus variable, where are we sitting now?
As far as so if you're looking at prime rates, there's a couple classes, and this is where a lot of people actually get really confused. So when you purchase a house, you get CMHC. That's called the insured rate. If you're switching lenders and you're not refinancing or anything like that, you can switch into what's called an insurable rate.
Okay.
This is exactly why I still have a job.
Right.
Then if you refinance, you're now an uninsurable rate.
Okay.
So the difference between them is insured rates are usually the best rate that you could possibly get. Right. So that's sitting at around 5.5% right now, right? Insurable rates depend on how much loan to value the house is. If you owe between 75 and 80%, 65 and 75%, and 65% or less. If it's an insurable rate and you owe less than 65% of the value of your home, and your home has to be under $1 million value. Okay. There's so many little things, right? And you're on a 25-year amortization, then you qualify for the best rates on the market, whichever
the insurable rate,
insured rate, right?
Okay, so is an insurable rate is it insured?
Yes.
Okay.
So actually, an insurable rate is when the lender actually will pay for the CMHC or the general insurance. Okay. So the reason why their interest rates are so low is because default insurance in itself.
Low.
Low. Default insurance is basically an insurer telling the lender, if the client defaults on the loan, we'll pay you the whole amount of the loan. So the lender has zero risk taking that loan on.
Right.
That's why the rates are so
give
good.
The best rate.
Yeah. So they're between 5.5 and I'd say probably maybe 6.2.
Okay.
And then you have the standard conventional rates right now. They're sitting at about 5.34 or sorry, 6.34 to probably like 7%.
Okay. And
as of November 21st, 2023.
Exactly. Yeah. And that can and will change.
Yes, absolutely.
Okay. And so and those are fixed rates?
Yeah, those are fixed rates.
Okay.
Yeah.
And so fixed rates, so there's a lot of confusion around variable versus fixed and what is actually affects those things. So fixed rates follow the bond market.
That's right.
Which has gone up recently and then come back down.
It's been doing a roller coaster, but right now we're higher than it's been in the last, at least 10 years.
Right.
Yeah, we've seen it all year. It's been going up, down, up, down, up, down, up, down. But and typically what lenders do is when it goes up, they're quick to raise their rates.
Yeah.
But when it goes down, they're a little bit slower to reduce the rates. Right.
Yeah.
So
it makes sense because you don't want to pull the trigger quickly there and it jumps back up and
they need that buffer. They need that little buffer, right?
So then variable rates, what are we looking at?
Variable rate, so 7.2% is the prime rate, and then it's usually, depending on the lender, you could have prime minus 1.1%, prime minus 0.9%, and then some of them are like prime minus 0.5, 0.6, or whatever, depending on the lender. A lot of them are really aggressive with the variable rates, but there's also variable rates and adjusted rates.
Right.
This is why I have a job.
This is why you have a job.
It's just so confusing, right? So variable rates, you'll have a steady payment, where adjusted rates will adjust the payment depending on the fluctuations.
Right. And that's where people can get into trouble.
Yes. Well, because adjusted rates, the way that's designed is like if you say I have a 25-year amortization adjusted rate, then you are on track to pay off your mortgage in 25 years.
Right.
Where variable has a trigger rate. If it looks like your amortization is going to take you longer than 25 years, then it'll trigger and then they'll readjust. Either you have to pay money or increase your payments and so forth, right? So
or extend amortization.
Extend the amortization,
right.
Yeah.
Okay.
So
which there's been a lot of recently, I believe.
Yeah, it hasn't happened in years. I don't think it's probably in the early 80s is probably the last time that actually happened. So
yeah, and so speaking of extending amortization, then I don't think a lot of people understand how that might affect your overall payment, right?
Yeah, it's actually it makes a big difference. It helps with payments for some people. Some people need the cash flow, so we extend the amortization. But you have to look at it. And how I learned actually amortization is because I was in the automotive industry for a long time. So you'll have your typical 5-year, 6-year, 7-year, 8-year automotive loan. But then when you break it down on an amortization chart and you see the compounding of the interest rate, it increases the cost of borrowing, increases significantly the longer your amortization is. So, and this is what I tell people, if the people that I give a extended amortization to, I tell them, use your prepayment privilege. Once a year, they could put X amount of money on their principal. Right. It doesn't change their payment, but it reduces their amortization. And, if you, let's say you're on a 30-year amortization or 35-year amortization, and in the first couple of years you put down $100,000, you can save $100,000 in interest over the amortization of that loan just by putting that significant chunk specifically at the beginning of the loan. Okay. Of the mortgage, right?
Okay. And okay.
You could actually if you ever look at your mortgage over the whole amortization, and especially with rates like this that's going on right now, you're basically paying double the interest. Double the interest and principal, right?
Right, yeah.
So the amortization is a huge factor in that.
Is there, okay, so I have a couple questions. Is there a kind of breaking point or tipping point where it makes sense to either refinance or you're at the start you're paying mostly interest payments, right?
That's correct.
at what is there a point where it kind of flips to say, okay, now I'm actually starting to make some headway in my principal. I can refinance, or I can go get another place and rent this place out.
Yeah. So actually there is. So when you put it on a chart on a line, it's literally a bell curve.
Okay.
Right. So typically, and depending on the rates and stuff like that too, but typically usually halfway point, you're winning on that scale.
Right.
A couple of years ago, when the interest rate was low, it didn't really matter what point you were at. You're pretty much paying mostly principal.
Right, because rates were so low.
But as people are going to find themselves refinancing or renewing or whatever the case is with these higher rates, they're going to see a significant drop in the principal that they pay, naturally because of their rate. But it's a tough situation for a lot of people actually. But yeah, it does. There is a bell curve. There's an actual point where
right. Okay.
It makes more sense, right?
But it depends on multiple factors, I guess. Yeah.
It depends how far along you are to your amortization. Some people just renew and don't change their amortization. Some people renew and they're like, can we go back to another 30-year amortization? Essentially, you're borrowing from your future, essentially, right? Paying off the mortgage.
And so, but that is kind of a short-term goal, right? To say, okay, let me get through this and be able to afford these payments for now.
Yeah. Well, that's what's happening right now is it's kind of like a fight or flight situation for a lot of people because like if they've, when the interest rates were amazing 5 years ago, they bought a car loan, they bought a pickup truck, and it's $1,000 a month payment, and it was not too bad then. But when some people, their mortgage payments have doubled.
Yeah.
Right.
Yeah.
So now it doesn't make sense having all these other loans when things were good. Like the Bank of Canada said, we're going to have low interest rates for a very long time.
That's my next question.
Buy.
Yeah.
This is the best time to get a loan. Yeah. This is the best time to renovate your property and then ultimately that didn't work out very well. Right.
Yeah. So whose fault is it?
Well,
is it because it's funny because you see comments online. Everyone's quick to blame Trudeau for everything. And then you have, TIF and the Bank of Canada who said just what you said, rates will be low for a long time. Mm-hmm. Go spend money. Mm-hmm. So obviously there are factors, things change. They have to make decisions. Inflation went up, which probably should have been seen based on what they were doing. But I don't know. Can you, what are your thoughts on that? Can blame be placed anywhere, or should we not play the blame game?
I don't understand how they didn't figure it out.
Right.
Yeah. You know what I mean? Like if we have 5 apples and we have $5 and it's $1 an apple, right?
Yeah.
But if we get $10 and we have 5 apples, now the price of apples $2.
Yeah.
You increase the monetary supply, you're going to increase the cost per good. That's what causes inflation. Mm-hmm. Spending all this money on COVID and stuff, that wasn't great. In hindsight, that was a horrible decision, really.
Yeah.
Honestly, it's monetary policy. Everything goes top down.
Yeah.
Right. So why are people blaming Trudeau? Because he's on the top.
Yeah.
If he focused on like Canada first, would be good.
Yeah.
Why are we sending millions to this country, millions to this country, millions to this country when we have? What is that doing? We're printing more money.
Yeah.
We're increasing the supply. So cost of goods, everything is going up. I think I was making quesadillas and I bought two bell peppers.
Right.
And it was like almost $4 for 2 bell peppers.
Yeah.
I'm like, this should be like 24 cents each.
Yeah, I know.
You know what I mean?
Yeah.
Like, it doesn't make sense. And then where you go to other countries, you go to like Indonesia, you go to Bali or something like that, and it's like a penny.
Yeah.
So it's like, it depends on the government and the way that they're spending, and obviously that has a lot to do with it. Anytime the government sticks their hand into something, it's just too much waste. Mm-hmm. That's the problem, right?
And not only that, I mean, they, whatever they're saying inflation is, it's probably double because that's what it feels like, right?
Mm-hmm. they've changed the formula.
Exactly.
They've moved the goalpost,
Yeah.
so it's like not to look bad in their election year or whatever, right? So it's not a straightforward thing, but
there's a school of thought around anytime the government is offering you anything as well, like be wary of that. Yeah. What are your thoughts on the first home savings account? If any, it's a good to have. It just, the government's tried to do so many things to help homeowners and stuff like that, but what that's done, like I remember when Trudeau released that we'll match your down payment but we have a share of your house, right? Yeah.
And that was, and it was great. It's like, okay, cool, that means that the government's gonna, if I throw down 10%, they're gonna throw down 10%.
But they have ownership.
But the government has ownership. Their hand is in your pocket.
Yeah.
And it's like, if you sell, and if that 10% that they pitched in appreciates, so they basically bought a stock in your house.
Yeah.
If that appreciates, then you pay them back that money plus the appreciation of that.
But if it depreciates, you still owe them that.
That's exactly right. Yeah. So that was, I don't know, man. I think the free market it adjusts itself. Anytime that the government has put their hands on something, it's always caused a surge in demand or the need for people to jump in the market. And then what that does with home prices is obviously pretty evident. Right now, where people are still, it's end of the year. People are like, counting their dollars. They're focusing on Christmas. Mm-hmm. So the market's definitely slowed down recently. Mm-hmm. But as soon as they announce something, a new change in the market, it's going to affect things. And we don't want too much supply and we don't want too much demand. Yeah. There's got to be some sort of balance, right? So what do you think about the B2B thing? The Airbnb.
Oh, yeah, that's tough. I mean, okay. I'm of the thinking that, the government shouldn't be able to tell you what you can do with your own property. Mm-hmm. I understand having some form of regulation around it, but this like blanket just restricting across, cities or municipalities.
Major cities, yeah.
It's,
because when I go somewhere, I'll get an Airbnb.
Absolutely, for sure.
And
yeah,
it's like it's nice for me. I don't have to be in a hotel or whatever. Sure, I don't get chocolates on my pillow, but it's convenient for me.
Yeah. And I mean, okay, there's an element of it taking supply off of the market for people who need to rent or buy. Sure, there's some of that, and that's where you have restrictions coming in, where it being only your principal residence, or maybe they could make it a portion of a separate unit within your personal residence, or even a second. If you have two residents, you can Airbnb one, because they're owned by the same person anyways, right? So it's tough. I don't like the idea of just blanket getting rid of it, because that just doesn't make sense. You shouldn't be able to. The government shouldn't be able to tell people that that's what they can do.
And what about those people that like went all in, scratched every dollar, basically to buy these investment properties, and they're counting on these properties to.
Well, and that too, I work with a ton of investors, and Airbnb is become a legitimate investment strategy, and so people like that are buyer beware, I suppose. If you're buying in a market where they haven't already laid out the restrictions, then that's on you, that you're taking that risk. And I think that's one thing I recommend to anyone looking at going into the Airbnb space, is go into places that already have their policies in place, because they're not likely to change them at this point. They've already done that. And it's just, it's tough, because in Toronto, they put these restrictions on, especially on Halloween. I think they were like not letting anybody rent for one night or something along those lines at Halloween, to try to avoid having parties. But it's like, at what point do you say you can't, put your hand in and control people's private properties? Mm-hmm. So It's tough.
It's tough, yeah, especially when somebody's all in and they're counting on that revenue.
For
right?
sure.
And now it's like, they can't rent their condos out or whatever. Then they have to resort in long-term rentals, right?
Or midterm.
Right? So, and that's tough in itself because the risk of renting long term, there's quite a lot of risk there.
Exactly.
Too, right?
Yeah. I mean, why are we so slow to make changes in that area, but so quick to apply restrictions or just ban things in the short-term rental space? It doesn't make sense. Like, this has been an ongoing problem with rentals.
Even kicking out bad tenants. Like,
can't do it.
I remember during COVID, I had a client and they had this bad tenant. I couldn't. I was doing a reverse mortgage for them, and they basically couldn't because the tenant was still living there. So we're trying to kick out. We're giving money to a tenant. Here's $5,000. Here's $10,000. Move out, right? The client and the tenant finally moved out, and then the one client that I had passed away shortly after, like a week after that, because of the stress and things that it caused. Like, I'm just like, it just broke my heart so bad because, people, there's got to be some protection for the landlord. I believe there's protection for tenants, but however, squatting is not something that should be tolerated.
I've gone through it. I had a tenant in one of my rentals in Sudbury who moved in, I think paid the first 2 months maybe, then stopped paying for 8 months. And it took us that 8 or 9 months to get an appointment with the tribunal, and she moved out the day before the appointment and haven't heard from her since. They gave an order for her to pay, but obviously that went nowhere. And that's it. That's just, we just lost.
There's no authority to that.
Yeah.
There's I've heard stories of landlords having to live in their cars while their tenant lives in their home.
Listen, if that was my house, I don't care. I'm going in and pulling you out, because it's one thing if it's a rental property, sure. But if that is my house and my family is living in the car, no, I'm going
that's
in.
Fight or flight. That's fight or flight.
I don't know what else to tell you. That's
it's just, there's evil out there, right? They're like some people don't care or whatever, right? So
it's and I just I just can't even like wrap my head around the mentality of thinking that that's okay.
Yeah.
And there is this whole thing of every landlord's evil and has tons of money,
super rich and this and that, but sometimes they're not even turning a profit. They're just, at
this point, they're definitely not.
They're subsidizing their mortgage payment on that property and eventually pay off that property. Right. It's not, and it's an interesting statistic. It's 1/3 people own their house without a mortgage. 1/3 have a mortgage. 1/3 are renting. So that's a really interesting dynamic there, how that is. Right. Yeah. And
I get that, like, if for somebody to leave a rental and go rent somewhere else, their rent may double, at this point. So,
or people selling their homes to rent.
Yeah.
It doesn't even make sense. And it doesn't make sense right now.
Yeah.
Some people are like, I'm just going to rent. I'm like, you're going to pay more than what you're paying now. Or you strap up your boots and just, hone in on your expenses. Maybe you should quit smoking. Maybe you should quit Uber Eats or whatever. So,
and this isn't a landlord's fault, tenant's fault. This isn't. I don't blame any of those. We have a real problem in this country, and there seems to be just Band-Aid solutions that come out. And I don't like to just be like the government, this and that. But there haven't been any real solutions.
We need leadership. We need good, strong leadership that has a vision and is strong enough to lead people to the right decisions, right? Like, too many people want to be told what to do, and that's fine. That's how they live their life. I'm more of a free spirit. I like to form my own opinions and do my own research, but there needs to be somebody that's doing the stuff for humanity, not just for themselves. For instance, like Elon Musk does. Like every business that he's opened up is for the benefit of humanity. And meanwhile, he just turned into the richest man in the world.
Yeah.
It's like, that's a good, philosophy, right?
I mean, that's it. Your income is a direct result of the value you provide to people. Yeah. So,
yeah.
But yeah, that's a whole other
topic.
But yeah. And so what about these, I saw you posted in your story. I posted about it as well, as people walking away from these $300,000 down payments.
Yeah, it's crazy.
How are we supposed to get new housing when?
Yeah, it's interesting because, when people can't find a house, when the market is so flush with multiple offers, they obviously got sick of it, and they're like, okay, we're just going to go new construction.
Yeah.
We're going to put this $300,000 down on a property that's going to be built 2 years from now.
Yeah.
Right. The risk of that is, what if the property dips? I've had clients that purchased properties 2-3 years out, and basically when the bank required an appraisal on the property, and the appraisal, because it's such a unique custom house, there wasn't any comparables. The property came in $100,000 below what the actual settled price was, right? So they had to come up with another $100,000, right? Now that could have been done a couple things: gifted funds or private funds. Not everybody has a rich Uncle Bob that can give them $100,000, but some people are fortunate, some people aren't. But no matter what, there's always a will, there's a way, and we know that when you have a new construction, even if the appraisal came in low, in a year or two, I guarantee you that property is going to be much higher than as soon as there's more sales in that area, that type of dwelling and so forth, right? But it's real estate is a risky business. You just got to know, you just got to hedge your bets. You got to do your research. You have to listen to your professionals. Realtors understand, what's going on with the market directly. Mortgage brokers understand what's going on with the finance stuff. It's literally talk to everybody and get a good opinion, right? I don't trust people that like overpromise, like the sun, the moon, this, that.
Right.
It was actually funny. My mom's neighbor had a realtor, and he's just like, well, you should sell your house now and wait a couple years, and because the market's gonna drop or whatever, right? What ended up happening? COVID happened. Prices went up. Yeah. So they sold a nice 4-bedroom swimming pool, acre lot. And now with the money that they set aside while renting, they can only afford a condo.
And then everything went up, yeah.
They literally dropped their profit they made, just cut in half.
I mean, no one obviously could have seen that coming.
No.
Fair enough. But yeah, it's a bold
So like professionals like that shouldn't tell people this is exactly what's going to happen. Yeah. They should have that disclosure. This is what I think is going to happen. Yep. I might be wrong.
I don't have a crystal ball.
This is a decision that individuals need to make for themselves and weigh their risks, right?
And so I'm curious, actually, if the appraisal doesn't come in at what they expected it to, and they have to go borrow $100,000, is that the fact that they'll now have that outstanding bill going to affect their existing mortgage that they were about to get?
Yeah. So, So typically lenders like to lend on loan to values, essentially. So 50% loan to value, 80% loan to value.
So it depends on how leveraged they were?
Yeah. So depends on the leverage. So if, let's say, a property was purchased for $1.1 million and the appraisal came in for $1 million, that means that effectively, and the lender's only lending at 80%. So effectively, their mortgage is going to be $800,000, right?
Yeah.
If it was valued 1.1, then it will be 800 and 200,000. Yeah. Well, yeah, 8,200. So essentially, they'll only lend on that value based on 80%, right? So,
but what I'm saying is,
but the builder wants 1.1.
Yeah.
So who's going to cover the shortfall? It has to come from the client if it's not
fair. Yeah, of course. But my question is then, so they then go borrow $100,000 from somebody that they're paying a private mortgage on. Does that then change their qualifications for that $800,000?
Absolutely. So so if you're taking the money from borrowed funds, then your total debt service ratio, depending on the lender, you have to debt service those funds.
So can you then run into, okay, now I don't have enough to cover it. I've covered it. I've covered this $100,000 now, but now I don't have enough here because they won't give me the 800.
So for, let's say that situation, let's say they had an original mortgage with TD, and then they needed to get a second private mortgage to cover the difference.
Yeah.
But then TD looks at it and says, now that you're borrowing that $100,000, you don't debt service anymore. We have to decline you, right?
So they would decline totally, as opposed to like giving you 700 instead of the 800, and now you're responsible for coming up with another 100. They would just decline.
Yeah. So in that case, the clients have to look into alternative lending,
right,
or private lending, which the interest rates and the fees and stuff go higher, right? So it's not a great situation. But the problem, not like, I have clients that like get a mortgage and their debt service ratio is like really super low. And they can absorb that additional, borrow the funds and to make up the difference. But a lot of people, what I've noticed over the last like 5 years is like, a lot of people, when they buy, is like, what is the most I can afford?
Yeah.
Right. So it's like, okay, you're approved for $550. Okay, we're gonna buy for $550. I'm like, well, if they bought for $5, then they would have that little room there, right? But that's a risk some people take too.
Well, and I have that conversation often. Is that's your max? That's not what you should be.
You should be
getting.
buying. Yeah. And we've had clients that are just like, actually the client that you sent me, they're just like, okay, what if we throw down this much more? How much more can we afford? This, that? And it was just like, it was a back and forth. And I get it. Like, you want what you want. Like, sometimes it's like, this is your first home.
Yeah. And that's, again, I mean, there's a handful of things that, I have to repeat over and over again. And one of them is, it's your first home. It's not going to be your dream home. Get in, build some equity.
In the market.
Yeah.
And
then the other is get pre-approved before we start looking for a home. So,
and don't deposit your cash in the bank account.
Yeah, that one. Yeah, don't make big, massive lump sums of cash deposits.
No, and that's one thing that gets over. Not a lot of people pay too much attention to, but if you have large deposits over $2,000 going into your bank account and you can't explain it, that's going to be a problem when you're sitting at the finish line. You have to close tomorrow, and the bank's like, well, if you can't explain this deposit here, we think you're laundering money or something like that. So we can't close the mortgage, right?
Yeah.
And that's usually one of the last steps that a mortgage broker typically does is, let's see where the money's been moved around, because every situation is different. And I ask the clients, okay, where's the money coming from? Where's the down payment? Is it sitting there? They say, yeah, it's sitting in my investment account. Okay, cool. And then they're like, yeah, my investment account is cryptocurrency. It's like, oh no, I haven't had a problem where I couldn't close a deal. Like I've had to go get creative, especially with that cryptocurrency one, because they don't. The banks require 90 days of bank statements. Exchanges don't really produce 90 days of statements, right? And if they do, it doesn't even have their name anywhere on it. So I remember one time I had to get really drastic. I'm like, okay, why don't you film your screen of you logging into your exchange, and showing us, that this is your name, this is your email, this is how we identify you, logging into the exchange, show us the 90 days of statements. And that actually worked.
It worked. Wow. Okay.
It wasn't a document, it was a video.
Interesting. Well, I mean, that's modern day.
That's, you gotta
and that's good that they were willing to accept something like that,
Yeah.
because a lot of institutions tend to be stuck in the past with things.
Well,
So,
the main thing is they're like, well, we can't link this account to your client because the name doesn't show up on the same page or on the same statement. I'm like, okay, what if? And it worked.
Yeah, cool.
It was crazy enough to work. Right?
So creative thinking too, though. That's one of the hats that you have to wear.
Yeah.
You talked about reverse mortgages. Can you just talk about that a little bit more to explain how that works?
A lot of people have a huge misconception. They're just like, well, if you do a reverse mortgage, the bank owns your house. I'm like, well, when you have a mortgage, the bank owns your house.
Yeah,
anyways.
exactly. Yeah.
I mean, it is literally the exact same thing as a mortgage. The difference is you're not making payments and your principal is building.
Right.
Right. So if you're not making a payment, your principal is going to grow interest only. It's mainly designed for people in retirement, especially like right now. I'm getting a lot of those phone calls because, that pension, Canadian pension plan, and the OAS it's pennies. It's nothing.
Mm-hmm.
It's enough to cover your taxes and your heating. And instead of putting someone in a home and being able to afford them going into a home by selling their house, like older clients can stay in their house indefinitely with a reverse mortgage until both spouses pass away.
Okay.
And then what happens at that point in time is there's a mortgage. This is the principal owed on the property. The children can either, pay it off, refinance, take it over. So essentially the house doesn't, it goes to the estate and the children can actually still get the house.
So the lender's still making their interest payments.
Yeah.
Getting their interest payments.
Yeah.
Okay. Yeah. It sounds like it would be a handy tool to have, especially as costs rise and people get to an age where the income goes down.
Typically 55 and over is when you can get a reverse mortgage. However, there's been a bunch of new players that came to the market where there's no age restriction. So you can get creative with that as well.
Yeah.
So you remember how we're talking about debt servicing? So let's say you have an investor and he has multiple properties, but he can't buy this other property that he's, itching to get because his debt servicing. And what's one of his biggest payments are typically mortgage payments. He can get a reverse mortgage, eliminate that monthly liability, decrease his total debt service ratio to be able to buy another property.
So does it still qualify as a payment that he has to make? It just lowers it?
So there is no payment. The only liability on that property is going to be heat, or $100 a month in heat, $150 a month in heat a month, and property taxes.
But is he not still paying the interest payments?
He would be paying the interest payments on that property, right?
Okay.
So he would have to come up to a situation where he's got enough cash flow to make it work. Let's say he's buying a property and he's going to turn into a duplex, then that makes sense. The reverse mortgage would be open. So as soon as that he can get his ratios back in line, then we could switch him over into a regular mortgage so he does pay down that property.
And is he paying an increased rate?
The rates are basically around 7.5%, 8.5% right now, fixed. So
so
it's an increased rate, but they're doing that to obtain other properties. But you can only typically do a reverse mortgage if you owe only up to 40 or 60% of the value of your home.
Gotcha.
You can't be
you have to have some equity.
Yeah, you got to have equity there to cover the interest only. Yeah.
Okay. And so the market's slow right now.
Yeah.
I mean, it's seasonal. It's the climate. It's a variety of things. There has been a massive influx of realtors, real estate agents who joined the business in the last couple of years. And everything was great. And, and then as soon as they realized, the deals aren't just coming my way, I have to actually build a proper business. I have to, prospect. I have to put
Knock on doors,
put the time in and extend my time horizon. There's been a massive exodus of realtors leaving the business.
Huge.
Is the same happening in the mortgage world? Is that?
See, I don't have too much of a problem because I do a lot of like refinances and renewals and switches. So when the real estate market, basically,
You're not dependent on.
I'm not depending on
someone buying and selling.
It's for me to stay busy because I still have that 33% of the population that have a mortgage that I can tap into.
Right.
And their stuff either renews yearly or every 5 years or whatever the case is, right? And especially right now too, I've been doing a lot of refinances because, again, people pulled out too much money on their credit card. They put that deck on their credit card.
Yeah.
And now they can't handle the payments and the increased mortgage payments. So it makes sense. It's not good to consolidate the debt. Like, it's not good to take a 5-year amortized car loan and put it on a 25-year amortization.
Right.
Because you're now paying probably like quadruple principal on that amount, right? But in an event that, if the client doesn't do this, they're going to default and ruin their credit. That's, it's you got to weigh the pros and cons, right?
Right. Yeah. So, I mean, I guess you have a little bit of a different business model so that you're not necessarily as dependent. Did you notice more people get into that side of the industry as well as kind of the?
I've seen a lot of, I wouldn't say a lot, but a few realtors have reached out to me. They're like, "Hey, how's mortgage brokering?" It's like, but it requires a certain type of person.
Yeah.
Like if you can't sit behind a computer for 8 hours in a day, then maybe this is not the career for you, because that's a lot of the time I spend at my desk and working, eating, eating while I'm working, kind of thing.
Yeah.
So it's not for everybody. I would definitely say that. Personally, I came from like the automotive world, so I love selling. I love trading. I love, doing that stuff. And advising and meeting people. I definitely love that. But at the end of the day, my desk just stays busy with my deals, my brokerage deals, because I'm training other brokers and agents, and then other brokerages reaching out to me. So it's been pretty good so far.
Cool. Well, good, man. Congratulations. This has been like a Mortgage Masterclass. So thank you for that. I appreciate it.
Hopefully I didn't spin your head here.
Well, I mean, honestly, like I have some knowledge, obviously, because I'm in this world, but there's stuff that I don't know, and I always have questions, and I know people watching have a ton of questions.
You always reach out to me if you have a question. You're just like, "Hey, Martin, what do you think of this?" And, I'm quick to reply, and
for sure.
And we have a really good working relationship. Right?
Yeah.
So,
absolutely.
So it's good to have people that you can trust, that you understand their standard of care with the client, because there's so many, with the bank. I'm not trying to knock the banks and the people, they do a great job. However, a lot of people say that they get treated as a number. Here's my number.
Right.
I'm going through to get processed. Nobody cares. And I've even gone to people's houses where they're like, "Oh, we're about to renew. We're not sure. The guys at the bank don't want to get back to us." I'm like, "Okay, cool. What rate did they give you?" "Oh, 7 point something." "Okay, I'll give you a better rate." And as soon as I did, their retention squad comes in. It's like, "What rate did the broker give you?"
Right.
It's like,
It's
like, okay. And then they got a better deal. And they're like, "Yeah, sorry, we got a better deal." I'm like, "Good. That's exactly what I want." I want
exactly. That's
maybe
the goal.
we didn't do business today. Maybe you'll send me a client tomorrow, whatever. Right. So it's, it doesn't have to be that way. We're in the business to help people and
absolutely.
to give people sound advice so that they don't find themselves in a legal situation that's gonna drown them, right? So Yeah.
That's it.
Super important.
Yeah, I love it, man. Thank you. I'm going to link all of your contacts in below. So if people want to reach out to you, they can. And yeah, thank you so much, man. I appreciate you stopping by.
Appreciate you.
All right. Thank you so much for being here. I appreciate it. Thank you to Martin for being here. This is the Little Did You Know podcast. If you're in need of a mortgage, reach out to the man. We'll put his links below. Don't forget to like, comment, subscribe, and let's get it.